Okay, good evening. It's Ramey and Roland here from Cirrus Capital, and we're going to take you through our initial impressions on the Namibian budget that was released this afternoon. This is the budget for the MTEF period from 2017-18 financial year through to the 2019-20 financial year. We'll start with the outturn for 2015-16 and 2016-17, really focusing on 2016-17 at the moment. Basically, what the government expects for 2016 is growth of 1.3%. We think that this is quite ambitious, really. Our expectation is actually for a contraction in 2016, and I think many of the people listening to this that participate in various industry in the country will not have seen growth last year in real terms, that's inflation adjusted terms, but will have actually experienced contractions, and we think that the economy probably shrank by around 1% based on our expectations. Revenue is expected to be 56.43 billion, which is up slightly from the figures that were presented in October 2016, around 3.5%. And this is very much because of the SACU receipts, which have improved for the 2017 calendar year, and because 1/4 of the current fiscal year falls within the calendar year, this has helped for the fiscal year's revenue and boosted that slightly. Expenditure is expected, or was rather, 58.2 billion as of the end of February. So there's still a month left to go between that and the end of the the end of the fiscal year. Sorry. So that's 96.4% execution, mainly driven by the execution of the operational budget. The development execution is always a bit lower than the operational budget, but given that there is still a month of expenditure and we usually see a bit of a rush on towards the end of the fiscal year, we expect to see a relatively high execution rate for this year. What this will all mean ultimately is that we're expecting to see a budget deficit of roughly 10 billion. According to the MOF forecasts, this is 6.3% of GDP, but this is off that relatively ambitious GDP number, where, as I said, we think that GDP growth will be quite a bit lower than what the Ministry of Finance is forecasting. So as a result of this, the debt stock is expected to be around 66.75 billion at the end of the 2016-17 financial year. This is 42.1% of GDP. Obviously, this is above the 35% target. And as well as that, that 42.1% of GDP is quite ambitious once again because of that GDP number. So our estimate is that it's somewhere in the region of 45% of GDP actually. Contingent liabilities are expected to be 4% of GDP. To be honest, this is always a bit of a strange number, and I don't think that it's very, very well captured. I think there's a lot of implicit contingent liabilities on government which aren't really captured in this number, so where government would sort of be required to step in, but there isn't actually any paperwork to say that they must. But 4% of GDP is way below the 10% target, so theoretically not a big concern at the moment. On the revenue front, revenue is expected to increase a little bit this year, 9.5% above what we saw last year. And this is driven by a 5.5 billion increase in SACU revenue. So last year we had a repayment to SACU because we were overpaid in 2015, and we had a repayment of around 3 billion. Now this year that is out of the system, but as well as that, it seems that the forecast or the predictions for the pool, the revenue pool this year, is a bit better than it was even prior to that repayment. So we have got this big increase this year. Other than SACU revenue, we've seen a 600 million decrease in other revenue lines. This is basically because of the general slowdown that we're seeing in the economy. I think that this is very ambitious, to be honest. The likelihood of the reduction in other revenue being that low, I think, is quite slim, and we will probably see a bigger contraction in revenue because of the slowdown that we're seeing in the economy at the moment, coupled with that roughly 1% contraction in growth, or illustrated perhaps by that 1% contraction in growth that we expect for the 2016 calendar year. This is a 3.4% increase in revenue on the previous forecast for the current financial year of 2017-18, or the upcoming financial year of 2017-18. And after 2017-18, the forecast for the following year is dampened down quite a bit, just 1.4% growth. And obviously, this is in nominal terms, so it would show very low growth in the economy if that were actually to happen. And I think that this is quite positive in that it probably shows a fair reflection of the fact that the SACU receipts for the 2017 18 financial year are going to be a bit high and probably adjusted down the year thereafter. So I think that generally speaking, this revenue appears fairly credible. I think the one concern is just with regards to general revenue, non-SACU revenue, and whether the slowdown in the economy is being adequately compensated for in these numbers. But it's certainly, I don't think, going to be very far out. It might be very slightly out. Just looking at the revenue breakdown, what we see at the moment is the same that we've seen for a long time. Tax revenue makes up the vast majority of revenue. Non-tax revenue is very, very small. And if we look at a breakdown of where that revenue comes from, income tax on individuals, roughly 10 billion out of 58 odd billion. And, fairly normal for an economy like ours in our state of development. Non-mining companies, relatively small as well, and diamond mining companies, relatively small, but considering that it's just one company, from that company, it's a very large amount of government revenue. VAT is sizable. VAT is around 14 billion, and then taxes on international trade, which is basically the SACU receipts, represent roughly 37% of total revenue for the current financial year. And what you can see there in this chart is that VAT has increased a lot when compared to 16-17, but SACU receipts have increased a lot when compared to 2016-17, but are going to shrink once again in 2018-19, which we think is probably a prudent piece of forecasting. In the outer years, we see VAT expanding quite a bit. I'm not sure what the reasoning behind this is. If there's likely to be a VAT rate increase, I think that's a very slim possibility. But I think that is probably a little bit ambitious in the outer years with regards to VAT increases generally. If we just go and look at the numbers of exactly where this revenue is going to come from, as I said, around 10 billion from income tax on individuals, 2.2 billion from diamond mining companies, just under 6 billion from non-mining companies, 14 odd billion on VAT, 14 billion on SACU receipts and just under 5 billion from all the others in the current financial year. You can see normal income tax on individuals is not really is not increasing in 2017-18, but as I mentioned, I think that this might also be a little bit ambitious given the general slowdown that we're seeing in the economy. We're estimating, roughly 30,000 jobs are going to be lost in the construction sector over a 2-year period from the end of 2015 up until the end of 2017. Many PAYE employees losing jobs, unfortunately, and as a result of that, these income tax forecasts might just be a bit ambitious. Diamond revenue is actually expected to come down this year. We think that this is perhaps a little bit too pessimistic, given that we are expecting to see an increase of roughly 25% in diamond output this year, and diamond prices seem to be stabilizing somewhat. The one thing here is that Namibia has spent heavily on new vessels, so that may be the reason for the slight reduction in expected diamond revenue for this year. VAT fairly stable this year and then increasing by 1.5 billion in the next year and then another roughly billion the year thereafter. As I said, we're not entirely sure why that would be the case. SACU, as I said, big step up this year and then some normalization in 2018-19. And then the other line fairly stable, I would say. With regards to new taxes and new tax revenue, we're not seeing any major changes, which I think is quite positive. And I think that the main reason behind this is because we are waiting for a new revenue authority, which is expected to be launched next year, and we expect that we will see some tax changes there. I think that this is particularly positive given what we've seen in neighboring South Africa, where taxes have been increased, and I think this makes Namibia a much more attractive jurisdiction on a relative basis as well, that we've kept our personal income tax down. We still don't have broad-based capital gains tax, and various other factors I think make Namibia quite an attractive destination from a tax perspective relative to South Africa. The changes that we have seen and the changes that are being talked about for the future, I think, have a few general objectives. Firstly, deepening and broadening of the existing tax base. I think that speaks for itself and is a very positive focus. Curbing tax-based erosion, similar, I think also very positive. Curbing profit shifting and tax planning opportunities. On the first side, I think we all agree, any excessive or any transfer pricing is undesirable. We don't want to see that. But the tax planning, I think it's not necessarily a bad thing, but obviously the devil is in the detail. Improving overall efficiency in the tax administration, I think that's critical. It's something that the Ministry of Finance has been working on for a while, and I think that there's been quite a bit of progress made, but probably quite a bit more that can still be made there, and hopefully a revenue agency will help. But definitely it shows very, very much the right spirit and the right sort of set of priorities at the moment. The other revenue and new tax proposals that we've seen in this budget, as I say, nothing really major, but what we have seen is we've seen a sort of tampering down of the proposal for the presumptive tax. It's now being called a simplified presumptive tax. I think there was a bit of pushback when we talked about the presumptive tax generally, so it has been sort of tampered down, and there's nothing really particularly, no particular detail on this available at the moment anyway. An increase in the fuel levy is very small, really largely immaterial, not a particularly big deal. Two things that were mentioned in the budget speech, which I think warrant some more research. Unfortunately, there's very, very little data or information available on this at the moment. But the provision of tax on capital gains is expected to be expanded to provide for a wealth-based taxation on certain categories of capital assets. We're not sure what these categories are. We're not sure exactly what is meant by a wealth-based taxation in this regard. And then following on from that, there's tax proposals on a wealth tax are to be developed to embody the principles of a solidarity wealth tax. This is a bit peculiar in that it's not normal to tax both income and wealth. Obviously, one being the flow of wealth, and the other one being the stock thereof. And to tax both is peculiar. So we're not entirely sure what's going on here, but it certainly has moved from something which appeared imminent quite a while ago to something which now appears to be being considered far more carefully, and I think that there's a good amount of research and so on going into this. So hopefully we will get something out of it at the other end, which has been well thought through and will actually make sense. At the moment, the Ministry of Finance has embarked on a tax arrear recovery incentive program. Basically, what this is those with tax arrears can go to the Ministry of Finance and can get the penalties waived and 80% of the interest. And this is basically to try to ensure that people who have tax arrears do go and pay those tax arrears and then start contributing in the future. I think a very positive initiative from the Ministry of Finance. The big question here is just how do we ensure that people don't fall back into arrears quickly afterwards, and we have to run a similar recovery incentive a few years from now. But I think that the implementation of the program is generally very positive. The establishment of a semi-autonomous revenue agency, as I mentioned, is on the cards. It's expected to be up and running from the 1st of April 2018. I think that there's been quite a lot of work done on this behind the scenes so far. And so I think that things are certainly moving in the right direction from that perspective as far as we can see now. And on the expenditure side,
okay, so from expenditure, I think this graph actually shows you nicely the whole theme of the budget, which is a consolidation budget that we're looking at, which we can something that stands out quite a bit is how expenditure remains flat going into the years, especially into the outer years of the MTF. And I suspect the only reason why we've seen it actually increasing this year, so it's increased by 1 billion to about 62 billion, which is a mere 1.67% increase. And the only reason why we could see an increase in expenditure was because of the SACU windfall that we saw that Roland explained earlier. Something to note here is that in the outer years, we've seen many times in the past where you see this consolidation of expenditure in the outer years. However, when it comes to the actual budget in that year, then it's always revised upwards, and there's sort of a failure to commit to the consolidation in the longer term. There's a few points that also stands out to us when you look at the expenditure in the outer years, and that's the interest expense as an example, which we will show in a later slide, where interest expense is actually expected to decrease while debt stock increases, which doesn't make sense. And while there's a big increase in personnel expenditure this year, we also see that there's no increases in personnel expenditure in the outer years, which also begs to ask a few questions, and I don't know if that will be realistic. So basically this shows you an indication of where the budget is going to. As you can see, a big portion is going to personnel expenditure, which is the black bars at the bottom. We've seen it increasing from about 35% in the past to over 40% currently, and it's really a significant portion of the expenditure budget. This increases in personnel expenditure has came at the cost of social grants. You can see has decreased a bit, and then also at the cost of the construction sort of projects and renovation and improvement that was spent on. So this chart shows you basically the percentage changes that we've seen in the various subdivisions of expenditure. You can see three sort of sectors that benefited from it is the personnel expenditure that we've mentioned previously, a huge 15% increase this year, which both from a nominal perspective doesn't make sense, and considering the government's financial situation also doesn't really make sense. And then at the same time, the interest payments has gone up, as we've seen interest rates increase in a low liquidity environment, and government mopping up all liquidity in the local market. And then also on the back of some significant debt increases over the last couple of years, which has driven the interest cost. When you look at the cuts, there was basically broad-based cuts across all categories. You could see really on the, I want to say, luxury side of things, there was big cuts where vehicles is expected to decrease by almost 80%. And transport and travel allowances coming down a lot. So you could see there's really some seriousness coming to the government in terms of where they're going to allocate their spending, and they're very focused on how they're allocating their spending.
I think very positive in this regard is the cuts in vehicles, transports, travel and subsistence allowances. This is something that many have complained about for a long time, that there's just huge wastage in these areas. So it's very positive to see these steps being taken to bring that under control. The other thing that I think is interesting there is the transfers to state-owned enterprises, where there's been a big reduction in the transfers to state-owned enterprises. And I think that there's been a lot of talk about putting pressure on the state-owned enterprises to sort of sort themselves out and to become less of a burden on the state. So it's good to see that this action is now being taken in order to try to bring that state-owned enterprise expenditure under control.
One last point I want to make on this slide is that if you consider the cuts across these various subdivisions, if you look at vehicles, it's a big contribution to your retail and wholesale trade in terms of economic growth. And those cuts will definitely, and the retail and wholesale trade is has a big weighting in the GDP equation. And therefore it will definitely weigh on what we can expect from growth in the year ahead. Just to put it into context, the increase in personnel expenditure, you could see increasing from below 40% and projected to increase to close to 46%, and really making up the lion's share of the personnel expenditure.
Of total expenditure.
Yeah, totally.
Yeah, and I mean this is really very worrying. If you look at if you look at the increases that we've seen in personnel expenditure over the past few years, the number of people that have been employed by government has increased dramatically, but also the average wages have increased dramatically. If you just index average civil service wages to inflation in 2010, they would be 40% lower than they are today. But because of big above inflation salary adjustments, the civil service wage bill has just grown and grown and grown. And the big concern here, of course, is that once the civil service wage bill is set at a certain level, so now we're just under 30 billion in the current year, it will never go down again. That bill will remain at that level or increase going forward. And each time we reset that base, that is the new floor. It will never drop back below the level, back to the levels that it was at previously.
And this chart basically just clearly indicates the rebasing of personnel expenditure, as Roland just explained. You can see the light blue line showing what we've expected or what government projected in their previous budget, and how it just stepped up like significantly compared to the previous year, and then also the previous year budget, so coming in way ahead of expectations.
Yeah. And I think the other thing that's just important to recognize in this chart as well is the 2018-19 and the 2019-20 numbers. And there we're expecting very, very small increases in the civil service wage bill, and we're not entirely sure how this will be achieved. So it's a very difficult balancing act for the Ministry of Finance and for the government as a whole, for sure, but that something needs to be done here, absolutely no doubt can exist. And I mean, I think just to put this into context, this is a slide that we showed in our budget presentations last year. And at this point, Namibia's civil service wage bill relative to GDP was the 6th highest in the world. So we had the 6th most expensive civil service relative to GDP in the world. And we're up there with Zimbabwe, Lesotho, Swaziland, Mozambique, Botswana, and others. And far more expensive than South Africa. And at this point, last year, a year ago basically, the civil service wage bill relative to GDP was 13.6%. In today's figures, this has increased to 16.4% for the 2017-18 financial year. And that pushes us up 2 places further. It makes us the 4th most expensive civil service wage bill relative to GDP in the world. So this is definitely something that we need to address.
Then a topical theme over the last year, and it's come up in a lot of meetings and a lot in the press and so on, is the construction sector and how government has had a huge impact on the construction sector. And I think what this slide actually indicates is that basically the pain is not over yet. From last year's medium-term budget, we actually see a further adjustment lower in terms of expectations, and then on a year-on-year comparison, there is definitely going to be a further decrease in it, as discussed previously. However, some light in the tunnel is that we expect a rebound or there is a projection for a rebound in construction spending in the outer years.
Yeah, and I think what's again just important to note here is if you compare the expected construction, renovation and improvement expenditure for the upcoming financial year, the 2017-18 financial year, it's literally 50% lower than was the case 2 years ago in 2015-16. And this just reinforces our view that we're going to see huge job losses in that sector. Now, it's not just government. We've seen government reducing construction expenditure, but we've also seen a lot of private sector reduction in construction expenditure, particularly with regards to mining sector changes, with the end of construction for the Husab mine, the B2 Gold mine, and the Chudi mine. So we definitely are seeing that slowdown. Now, from this year onwards, things are expected to improve. From this upcoming financial year onwards, things are expected to improve, but they certainly aren't expected to bounce back to the kind of levels that we saw previously. So hopefully the pain will be over for the construction industry, or will be reduced for the construction industry from the end of the upcoming financial year, but it certainly won't be a return to the massive boom years that we saw previously if the current budget figures are anything to go by. On the transfers to SOEs, this has generally been a point of great contention for various reasons in the country, and I think if you look at this, it definitely looks like we're seeing some improvement in terms of the allocations to state-owned enterprises. So more than 50% of the total transfers to state-owned enterprises for the 2017-18 financial year are basically to education. So the Namibia's Students Financial Assistance Fund is the largest recipient of transfers, and then the University of Namibia and the new Namibian University of Science and Technology, the old Polytechnic. Thereafter comes Air Namibia. I think that that remains a point of great contention. And the other thing that we'd just like to point out here is the transfers to Transnamib. Transnamib is in a real mess at the moment, and these ongoing transfers to it appears to just be a good way to disappear money. Otherwise, I think Air Namibia is still something of concern. We still don't really know what the net effect of Air Namibia is, whether the financial costs of continuously supporting it outweigh the economic benefits to the country or not. So that's a piece of research that I think desperately needs to be done. And that situation is very much changing at the moment as we have all of these new carriers bringing in tourists to the country. So whether Air Namibia needs to maintain that very expensive long-haul flight is certainly questionable at the moment. And so it is a big transfer in these more difficult financial times to be making to that airline. So certainly something where we think there is some room for improvement. Just looking at the same thing over the MTEF period, very similar story. The main contributions or the main transfers being to the education, then Air Namibia, then the training authority, and then Transnamib. So I think the concerns and the positives are much the same. The Students' Assistance Fund, I think, is something that we need to be spending money on, but it certainly is something which needs to be cleaned up and worked on at the moment. There's been a lot of negative press about it, and I think for good reason. But it does seem that the ministry responsible is putting a lot of effort into trying to sort that out at the moment, which I think is commendable. Moving on to debt and the deficit.
Yeah, basically what we've seen here is that 10 billion deficit what we had in 2016-17, that equated to a number that we see as 7.3% of GDP. It differs a bit from what we see in the MTF. And we expect this to consolidate into this current year at around 6 billion, which will equate to about 3.5% of GDP.
Yeah, and I think what you can see from here, which is quite interesting as well, is that the Ministry of Finance appears to be of the view that we'll be running a very small primary deficit this year relative to what we have been running, of just 900 million, taking the total deficit up to just under 6 billion when we take into account the 5 billion interest payments that are required, or funding payments that are required. And then to run a balanced primary budget, or a zero primary deficit next year, and then actually start running primary budget surpluses the year thereafter, is extremely ambitious. If you just look at what we've seen in the primary deficit over the past few years, this is very ambitious. We definitely like the thinking, and we definitely like the push to try and consolidate. And I mean, the minister must be commended for his efforts in this regard, but I think it is quite ambitious. What we do see here, though, is that SAPU windfall not all being spent, which I think is very positive. That 5.5 billion increase is the main reason that we see this containment in the primary deficit. That much of that will be used to reduce the budget deficit rather than just spend. So I think that this is generally quite positive, but quite ambitious. One thing you might notice is that our numbers on the deficit are a little bit here and there and don't match up with those of the budget speech. And there are two main documents in the budget. One is the estimates of revenue and expenditure, and the other is the medium-term expenditure framework. And the two are reporting different deficit numbers. The 2016-17 estimate in the estimates of revenue and expenditure is just under 10 billion, whereas in the MTEF it's just under 12 billion. So quite a big difference there, and we're not entirely sure why that is. From what we've seen on the debt issuance side, we would say that the MTEF number is probably closer to correct. But there is an adjustment now in terms of portfolio revaluation gains on the currency because of the hard currency, the unhedged hard currency debt that we have. And that may explain the difference there, that one's not taking that into account and the other is. But that's the reason that the budget deficit numbers may differ somewhat. The one thing that we would just like to mention here is that these promises of fiscal consolidation are definitely reassuring, but I think they must be taken with a pinch of salt. And basically we've put this graph together that shows each individual line represents a single budget. And you can see the promises of fiscal consolidation are not something new. And the promises of fiscal consolidation that we see now, we believe, are much more credible than those of the past. But that doesn't necessarily mean that they will certainly occur. But it looks a lot more likely that they will than some of the previous promised paths of fiscal consolidation. Just if we compare this path of fiscal consolidation to what we've seen previously, you can see from this chart that the purple line is the most recent budget balance. And you can see there that that's actually moving out. So we're actually running bigger budget deficits relative to GDP than what we forecast in the midterm budget. And this just reinforces our previous point. And you can see here that the budget deficit for the 2016-17 year looks to be fairly sizable, bigger than was budgeted for in the midterm budget in October. And the same with the 17-18 budget, and the same with the 18-19 budget, and the same again with the 19-20 budget. So it does seem to be a theme of slightly bigger budget deficits than originally forecast. And it just once again reinforces that view that we must just be a little bit cautious when it comes to this fiscal consolidation path. Although, as I said, I do believe that the Ministry of Finance is very serious about trying to pursue this path, and I think that there is quite a bit of dedication to it. So I think it is much more credible than what we've seen previously. Just looking at the debt stock, we just threw this chart in. It's actually a chart that we had in a different presentation, but we thought it was interesting. And this is the debt stock back to 1990, and you can see that we basically had no debt in 1990, and that's now increased to just under 70 billion worth of debt at the moment. But the point that we really wanted to make here is that the big increases in debt happened in 2015 and 2016. This isn't really a long-term thing, but this is very short-term that we had these huge increases in the public debt stock. And that took us from a debt to GDP ratio of under 25% at the end of 2014 up until very close to 45%, or what we believe is basically nearly 45% now. So it's really just in the last 2 years that we've had this big ballooning in the debt stock.
Yeah, basically this chart just builds on what Roland has said just now, and it's an indication of what the MTF actually expects or projects in terms of debt outstanding and debt to GDP going forward. You could see the slight increases in debt overall to just over 70 billion in 2017-18, and then continuous growth into the outer years. However, you could see the debt to GDP actually expect to decrease a bit, but we should warn that that's on the more ambitious Ministry of Finance numbers.
Yeah, on the Ministry of Finance's GDP numbers.
Why we include this chart is that there will be an interesting situation later in the year when we come to July 2017, where we will actually have the GC18, which is a government bond maturing in 2080, that will actually fall within a 12-month maturity profile, and it ramps up the debt maturing in 12 months' time quite significantly. You can see if we assume that TBS as it is currently just stays unchanged, with the GC70 maturing, I think that's still about 1 billion that should be rolled after the switch auctions that we've witnessed, and then the GC18 coming into line. It's about 20 billion of debt that will be, or just short of 20 billion of debt that will be maturing in 12 months' time. And I think that's a steep ask of government, and especially in the light of a possible credit rating downgrade, it might not be as easy to roll these debt into just the same number.
Dated, yeah.
But at the same time, another implication might also be the cost that comes with it. If this debt gets rolled into a junk sort of rated debt, then it will come at a steep cost.
Yeah. So obviously, when the Ministry of Finance issues debt, then they lock in the price that they issue it at for the most part. And when you're rolling these big amounts, then you could end up locking in a much higher price should that debt be relatively expensive as we see it at the moment. If you look at the average cost of issuing the GC18, for example, it was way lower than what the cost of rolling that's going to be. This of course can be mitigated by starting with switch auctions on the GC18 as quickly as possible, and really putting a cap on the treasury bill issuance going forward, and trying to slowly roll or reduce TVs as a percentage of total government debt.
Just coming back to a point that we've mentioned earlier, and that's with regards to the consolidation in the outer years in terms of expenditure. Interest costs are expected by government to actually remain or actually decrease going forward. As you could see here, the black line on the right-hand side, that the domestic interest payments actually expected to decrease, which doesn't make sense given two facts. First of all, we've seen big increases in domestic debt, and then secondly, interest rates has also increased over the past years. So I think this is a potential area where we could actually see an increases in the total expenditure in the outer years.
I think the other thing that's just interesting there is while this debt stock is increasing, the total interest cost is coming down, and as Rene said, that's just really peculiar. So we're not sure, and we're not entirely sure what's driving this, but it certainly doesn't look correct to us, and it obviously implies that the average interest rate on government debt is declining. If anything, we believe it would go the other way, and this could cause the total expenditure to balloon in the outer years, or not balloon, but certainly grow faster than what's currently forecast. So it really doesn't makes sense as far as we can see. There may be some reason for it that we're not seeing, but I don't think so.
Yeah, then basically just as a fresh reminder that we always put in our budget presentations is the benchmarks that the government has sort of self-imposed on themselves. And I think some of the outliers that sort of waves red flags is the total debt to GDP that's currently at 42% according to the MTF, compared to the 35% benchmark. Then foreign debt to GDP is currently 16.6%, or projected to be 16.6% relative to 7% benchmark. And then also external debt as a percentage of total debt close to 40%, where it's targeted to be around 20%. So some of these benchmarks definitely being breached and sort of flashing red lights that there should be focused attention on these things.
The other thing I think that's just important to note here is that because we believe the Ministry of Finance growth forecasts to be a bit ambitious, I think all of these ratios are actually slightly too low as well, because the denominator in all of these calculations, except for the external debt versus total debt, is GDP. The total percentage will be a bit higher. So already I think we have a breach on quite a few of these indicators, but at least it does look like most of them are stabilizing and improving, or at least not getting worse going forward. So I believe if we do follow this fiscal consolidation path that we have been promised, this situation won't continue to deteriorate. One thing that I think is important to note here is that over the past few years, these forecasts have looked a lot better than the actual outturn. And if we go back to the 2014-15 borrowing plan, for example, the expectation at this point is for debt to GDP of in the low 20%. And obviously we're double that at the moment. So I think the Ministry of Finance has its work cut out to rebuild credibility in this regard. But I think that the steps that are being taken at the moment are quite positive, and I think that credibility can be rebuilt relatively quickly if they do stick to the fiscal consolidation path that they've promised. So maybe we can just sum up, because this is getting quite long now. So we say the good, the bad, and the ugly here, and I think that there are some positives and some negatives that we can just quickly sort of summarize for you. Firstly, on the positive side, we left this budget speech today feeling very, very much more positive than we had previously, and for a number of reasons. I think first and foremost, the fact that government revenue is going to be a bit better than previously thought, and that it can facilitate this slight increase in expenditure that we see this year, that roughly 1 billion increase in expenditure that we see this year. And that should help to smooth out this adjustment process that we're going through at the moment. We still need to see the adjustment. We still will see government expenditure having to be sort of curtailed or controlled more in the next few years, but at least it helps to smooth that process out somewhat. And I think that this economy at the moment really needs it. The economy is struggling. I think many industries, many sectors are struggling, and I think that little additional adrenaline boost can perhaps help more than people realize. As well as that, it was just a year ago where we felt very, very frustrated with the fact that we didn't believe that there was broad recognition of the circumstances that we were facing in the economy. The general growth forecasts were still for between 4 and 5.5%, depending on the institution you talk to. And we just didn't see where that growth was going to come from. Now I believe that there is really broad acknowledgement of the current challenging circumstances that we're facing, and I think what's very positive in this regard is that the steps that are being taken to address these challenging circumstances, I think, are very much the right steps. I think that the Ministry of Finance must be commended for that. Cutting expenditure, it's never easy, it's politically unpopular, it's socially unpopular, and I think it's that the Minister and the Ministry must be commended for those efforts to cut expenditure the way that they have. I think as well as that, what we're seeing now with regards to the restructuring of certain state-owned enterprises and things like that, I think is very positive. And once again, it's acknowledging some of the challenging circumstances that we face. Also cutting out a lot of the wasteful expenditure that we have seen in the budget. I think that this was badly needed. It's the old saying of when the tide goes out, you see who was swimming with their trunks on and who wasn't. With the tide going out now, I think that what we're seeing is that very much the right steps are being taken to try and address these issues. So I think that that's very positive. The deficit projections are very positive. I think we desperately need this fiscal consolidation. I think the fact that we aren't spending the SACU windfall this year, or the SACU recovery rather this year, is very positive. Because of what we saw the past few years, credibility is still an issue. But I think that the commitment that we're seeing from the Ministry of Finance at the moment is very strong. And so we think that credibility will be rebuilt, and that we will actually see the fiscal consolidation that is being promised. As well as that, on the positive side, there are many kind of soft promises at the moment with regards to the policy space particularly. There was mention of the equitable empowerment framework that I think has ruffled many feathers recently and made many investors very, very cautious about putting their money into this country. As well as that, the Investment Promotion Act, and it looks like both are going to be rethought and reassessed, which I think is extremely positive and badly needed. Particularly during these challenging times for the economy, we must do absolutely everything we can to attract investment and not chase investment away. It's one of the critical factors of your GDP, and as a result, your GDP growth. And so we desperately need to make sure that we have a very investor-friendly environment in the country. And if we continue to do that, I think that the long-term future remains fairly bright. As well as that, the Procurement Act is something very positive. Some of the mentions about state-owned enterprises and what we're likely to see with regards to restructuring of state-owned enterprises, more accountability in state-owned enterprises and so on, I think is very positive. And then the Minister mentioned overspending by accounting officers within the government offices, ministries and agencies, and I think it's a bold step, really calling out some of the people who are behaving in a less desirable fashion with government finances, or with public finances rather, and I think that's badly needed, so another commendable step. As well as this, the Regulation 28 was mentioned in the speech as well, and this is the pension fund and life insurance, Regulation 15 as well. And it looks as if the regulation will, the local asset requirement under that regulation will be increased to 45%, not to 50%, and it'll be done in, I think, a pragmatic manner over a few years with consultation and so on. So it looks very positive and a much more positive approach than what we saw previously, I believe. On the negative side, I think the civil service wage bill is by far the biggest issue. This is something that we're very, very concerned about. The 15% increase this year is very worrying, and especially considering that it's an already extremely bloated expenditure line. And now what we see is the civil service wage bill represents very nearly 50% of total revenue and the high 40% of total expenditure. And this is extremely concerning. It's a situation that simply can't continue in perpetuity. Defense spending is the other thing. We haven't gone into details in terms of who's getting what, but defense spending, I think, is a big concern. We have seen some cuts here, but between defense spending and the police spending, we basically have roughly the same expenditure as we have on basic education, and that's just really not a good prioritization of the finite funds that we're dealing with at the moment. And defense spending is about 50% of that total. So defense and police spending are roughly the same amount each, which is very concerning. The wealth tax that's mentioned in the speech, I think, is also quite worrying. Not necessarily because we don't need to reassess some of our taxes, but just because it's peculiar to tax wealth and to tax income. As I say, the stock and the flow the stock and the flow of wealth. And so that's peculiar, and I don't know why we continue to bang that drum. It really doesn't make any sense as far as we're concerned, and we believe that it would be far more desirable to focus on, either reassessing the income tax or to move to a wealth-based tax system, which is obviously a huge amount of admin and so on, and it's not really being used in many countries in the world. Obviously, a capital gains tax is a tax on it's on the flow rather than on the stock of wealth, so it's a change in the value of your capital assets. And that obviously doesn't constitute a wealth tax either. From a construction perspective, I think it's quite positive to see the removal of a lot of the wasteful expenditure in the budget, and that we are quite happy about the removal of a lot of the government offices and things like this non-productive capital expenditure. But the construction industry is really under a huge amount of pressure at the moment, and we believe that this process probably could have been carried out a little bit better. I think that the big concern here is not necessarily about a reduction in government spending on construction activity, but it's really about the cash flow implications if government doesn't pay its bills on time. And I think that was probably the big issue that we saw through the 2016 calendar year. So hopefully we'll start to see that being addressed going forward, but at the moment we certainly still sit with a government that has fairly sizable arrears to certain industries, less so to the construction industry now, but there certainly are still some issues there that need to be dealt with. I think that the final two concerning points are around, firstly, revenue and how credible the revenue forecasts are. We're not really sure what will happen to SACU in 2018, and we believe that given this big increase that we see now, there may be a repayment again in 2018. So I think that we need to prepare ourselves for that possibility. And the other thing is just we're not that clear yet on what the feedback loop from a revenue perspective is going to be with regards to the growth slowdown that we see in the economy at the moment. Because of operating leverage, because of a loss of jobs in the private sector and so on, there is a big possibility that that some of the revenue lines for the 2017-18 financial year will not be as good as they are forecast to be. So that's definitely something that we need to keep an eye on. Although we don't see big howling differences between what is forecast and what is likely to be the outcome, we do think that there may be a little bit too ambitious, some of those forecasts. I think the final point is just with regards to funding the deficit. Government lent very heavily on GIPF to fund the deficit in 2016-17. And we believe that if this continues going forward, it will really create a long-term liability for the taxpayers of the country, an additional long-term liability. And it's also a very imprudent thing to be doing if it continues going forward. Up until this point, the GIPF has bought reasonable amounts of government assets, probably slightly more than we're comfortable with, but certainly still justifiable amounts of government assets. But if it continues going forward, I think that there certainly will be some concerns about the long-term sustainability of that model, and then also the potential impact on the net actuarial asset of the GIPF, which we believe could very fast turn into a net actuarial liability. So I think that those are really the main points. Thanks for your time, and you're welcome to contact us on the email address given here if you have any questions or if you'd like any more information. Cheers.